Hello dear students. Let us continue our journey with the module 33 of unit 4. And today we are going to discuss about balance of payment and national income accounting. In the previous module that we studied, we focused on the national income in an open economy scenario and how it differed from that of a closed economy scenario. In an open economy, the national income accounting was shown by an identity y is equal to c plus I plus g plus x minus m, where y represented the national income, c represented the consumption, I investment, g represented government expenditure in the economy. X minus m was denoted as the current account balance in our model. And today, we are not only going to discuss about this current account balance, but how this current account balance, which is a part of a broader structure, which is known as the balance of payment structure of an economy. And this module is going to focus primarily on this balance of payment. Now, what is balance of payment? Balance of payment is a systematic record of all the transaction of an economy with the rest of the world for a given period of time. So basically, balance of payment will be showing all the inflows and outflows of a country with the rest of the world. Now, why do we need to study this balance of payment when we are already studying the national income accounting? The chief differences which can be pointed out between that of balance of payment and the system of national accounting is that, number one, balance of payment has one important characteristic, that it records all transaction between the resident of a country and the rest of the world. That is, all transaction has a resident from home country and another a resident from abroad. The second important point of balance of payment is that balance of payment records all assets and liability movement as well as the exchange of current produced goods. Mind you, in the national income accounting, we would focus that only currently produced goods and services were taken into account. But in case of balance of payment, both the current goods which are produced in the economy as well as changes in the assets and liabilities are focused. The third important point in case of balance of payment is that it shows both the traded items as well as the associated payments or credit related with it. That is, in national income accounting, we were focusing more on the monetary side, but now each transaction in balance of payment are recorded in two dimensions. What do we mean by that? For this, we will be understanding the double entry accounting system. In the double entry accounting system, like that, followed by balance of payment, is that every transaction that occurs are recorded with two opposite signs, that is debit and credit. Now, what are credit and debits? Mind you, all international transactions in balance of payment is recorded as credit and debit. Credit indicates all such activities which results in inflow of foreign currency to the home country. Whereas a debit represents all kinds of activity that leads to payment to the foreign countries. Credit is recorded with a positive sign and debit is recorded with a negative sign in the balance of payment. We will see this table of how some of the items are recorded under credit and debit. Now under credit, we will be including all exports of goods as well as services. Increases in financial liabilities will be included in credit side, or any activity that leads to reduction in the asset of the country will be recorded in the credit side. Whereas the opposite structures will be recorded in debit side, like imports of goods and services, any activity that increases financial assets of the country, or if there is a decrease in liability of the country, it will be recorded in the debit side of the balance of payment. Activity that takes place in economic jargon has two sides. For example, if you purchase an item, that item is what you get, but correspondingly, you are going to pay a money for it. That means if the item comes to you, the money is what that goes out. Similarly, if a country is exporting, the country is receiving money for it. However, the goods and services are flowing out of it. Export, though recorded in the credit side with a positive value, also means that the money might be credited into the bank account of the foreign nationals for the particular country, and this will be indicated in the debit side. In the double entry bookkeeping system, as I have been pointing out, every transaction has two aspects, a debit aspect and the credit aspect. Hence, technically, the sum of all debits and credits must be equal to 0 by principles of double entry bookkeeping. In that sense, in accounting nature, a balance of payment will always look balanced to us. We will move and talk about some important classifications of balance of payment. The chief classifications are of two accounts that we are going to focus. One is the current account, and the second is capital and the financial account. Now, what is a current account? Current account comprises of goods, services, income, and current transfers. What would we meaning by goods? Goods are exchange of merchandise or all tangible goods that are sold in the market. Services refer to intangible transactions like that of banking, insurance, transport, etc. Third is income. In terms of income, we'll be talking about the compensation of employee, that is the return of the labor who are living in other countries and repatriating. Now, by financial investment or financial income, we'll be meaning the returns like interest income on financial instrument or dividend on corporate stocks. From indebted countries, there are interest payments which are made to the country, which also constitute an important portion. It may also be an interest payment made to the foreign country on the loans that have been taken. Finally, if we talk about the current transfers, this may include transfers from the government in unilateral nature, or it can be the remittances which are made to the laborers, etc. Now, one example of current account transactions can be, suppose Bangladesh is importing sugar from India. Now, this will be reflected in the credit side of an Indian balance of payment in the current account structure. The second is the capital account and the financial account. Mind you, this has two aspects. One focuses on capital, other focuses on the financial account. The capital account records all acquisitions or disposals of intangible non-financial assets and property rights such as trademark, patents, copyrights, leasing agreement, and mineral rights. Example of debt forgiveness is also taken into account of capital account. For example, if Indian government, which has lent money to Kyrgyzstan, forgives suppose 1 billion of loan given to Kyrgyzstan, this will indicate a decrease in wealth of India by 1 billion, and this will be shown in the debit side of India's capital account. Mind you, the capital account transactions for countries are very low. As a result, it is clubbed with that of financial account. And as a result, we have capital and financial account. Next is the financial account. In the financial account, all transaction that arises from the purchase and sales of financial assets are recorded here. Now, what are financial assets or assets in general? Assets are in forms of wealth that can be in form of money, stock, machinery, factory, buildings, government debt, etc. Now, the financial account balance of the balance of payment records all international transactions which arises from sales or purchase of financial assets. Now, let's take an example. Suppose Indian company buys a factory in Sri Lanka. Now, this implies that the India's balance of payment will have a debit in the financial account to enter as a debit because this transaction requires India to pay to foreigners. Whereas, if India would have sold an asset to a foreigner, this would have been put into the credit side of India's balance of payment. Now, the difference between the country's purchase of financial assets and sale of financial asset will show the net position of financial account or the net financial flow for the country. Now, financial flows in the financial account can be of four types. One, direct investments in forms of equity investment or greenfield investment. There can be portfolio investment in shares or debentures of the country. It can be other investment which can be in forms of trade credit or borrowing from IMF. Or there are reserve assets which are required to make immediate payments of foreign debts by a country. In this table, we can see an example of a balance of payment, and this is being given in the balance of payment module of 1993 by the IMF. So if you see, the first is the current account, which takes into account the net of goods and services, the income and the current transfer as discussed earlier, and capital and financial account, which are divided into capital accounts, which looks into non-financial transactions of the country, and the financial accounts, which looks into the changes of assets and liabilities of the country. We note that as any international transaction gives rise to an offsetting credit and debit entries, the sum of the balance of payment of the current and capital account must be equal to that of the financial account. If you remember the link, in order to have the current account transaction and capital account transaction, there must be an equal and opposite financial account transactions to balance it. Hence, if a balance of account is balanced, that means capital account plus current account must be equal to financial account. We are going to talk about the net error and omission that is shown in the balance of payment. Now, by principle, debit must be equal to credit and the balance of payment account must be balanced. But in reality, this may not be so. That is because the data are derived from different sources. Sometimes some may be overestimated, there may be under-recording in some cases too. The balance of payment, therefore, contains one item called net error and omissions that is set as equal to and negative of the sum of all the accounts in the balance of payment. Net errors and omission can be considered as a residual to ensure that the balance of payment is having a sum equal to 0 in practice. But there is a technical problem in considering this net error and omission as the balance of payment or the residual. Why so? Because remember, the balance of payment records credit and debit. This credit may be underestimated sometime, and this underestimated credit may be offset by having an underestimated debit in other case. Or there may be a case of misrecording, and these two misrecordings may cancel out each other. Remember, since the credit and the debit balance offset each other and the mistakes may be undermined, in that case, we cannot take the residual of this account of net error and omission as the problems or the accuracy measure for a balance of payment statement. Next, we talk about the official reserve transactions. Of many financial transactions, this one is to be noted because this is done by the central bank of the economy. Remember, the central bank of the economy balances the money supply and takes control of it. There are some transactions which are made to maintain the cushioning of the economy against economic misfortune. The central bank of the economy may keep reserves of foreign assets and different kinds of instruments like treasury bills. If the central bank of the economy changes this reserve position to meet the requirement of the country's balance of payment, then these are official foreign exchange interventions, and these are recorded into these official reserve transactions, and they are treated like the transactions which are done in the earlier cases in the balance of payment. Next, is the balance of payment always in equilibrium? In the accounting sense, debit is equal to credit. That means balance of payment must always be in balance. To answer this question, we need to look into two important flows in the economy: the autonomous flows and the accommodating flows. The autonomous flows are those flows which takes in an economy without taking into consideration the position of balance of payment, and these are done purely for the business purpose or economic purpose. A country may actually have exports more than imports, or may have import more than export. This puts the balance of payment in a disequilibrium position. In order to bring the balance of payment into the balance, there are some transactions which are done, which is also known as gap filling transactions, and these are known as the accommodating transactions. For example, if a country has a current account deficit, the officials may end up selling gold to generate resources to balance this over excess import than export. Suppose in the balance of payment, we draw an imaginary line, one below the autonomous transactions and above the accommodating transaction. The difference in the account of autonomous transactions will be in opposite direction balanced by that of accommodating transaction. In terms, the sum of the autonomous transactions and accommodating transaction is equal to 0, and that gives the balance of payment equilibrium. However, in true sense, the difference in the autonomous transaction account shows the position of balance of payment. If the autonomous receipt is more than autonomous payment, we have a current account or a balance of payment surplus. And if the reverse is true, we are having a balance of payment deficit. In the case of surplus balance of payment, the country ends up giving those resources to other country in forms of probably a loan. And this will balance the country's balance of payment because a surplus is balanced by an accommodating outflow from the country. However, if the autonomous transaction account shows a deficit, the country borrows or there is an inflow accommodating transaction that is done to maintain the balance of payment equilibrium in case of disequilibrium. Thus, the sum of autonomous transaction and accommodating transaction is equal to 0, or the sum of autonomous transaction is equal to the negative of sum of accommodating transactions. This is a sample example of a balance of payment of that of USA, and we can see how the accounts have been distributed in forms of the current account, the capital account, the financial account, and the net errors and omissions, which we talked a while ago. Now, we will talk about some concepts of balance. The first is the balance of trade or the trade balance. The trade balance shows the difference between the export of goods and the import of goods. Mind you, it only focuses on goods and not on services. Although there may be some questions like why not services, because there is not much of difference between export of goods and export of services in terms of return. A sale of good to foreign country and provision of service to the foreign country will still provide us the same return in terms of the monetary returns. However, balance of payment is a good indicator by taking into account the balance of trade so that we can see the direction of the trade of the country. Next is the current account balance, and the current account balance basically shows the balance of net export with the net import. And this is a very good indicator to show how much the resources are available domestically, that is what is produced, and what is absorbed in the economy. A current account deficit in short run or for a particular period of time may not be a big problem, but a stagnant and a long-term deficit in the current account may be an indicator of sustainability issue for the economy in the medium or long term. Now, the overall balance talks about the total national balance of payment account of the country, and there is reserves and liabilities which is required to balance the movement in the current account as talked earlier. Now, we are going to link the key aggregate of the balance of payment account with the national income informations. We have the various indicators C, I, G, X, M. NY will be indicating the net income from abroad, and GDP indicates the gross domestic product of the economy. GNDY is the gross national disposable income, CAB is the current account balance, NCT is the net current transfer, and NKT is the net capital transaction in the economy. NPNNA is the net purchase of non-produced, non-financial asset, that is the financial account balance. And NFI is the net foreign investment, that is the borrowing and lending of the economy. If you put it in the national income aggregate, we have GDP is equal to C plus I plus G plus X minus M, where X minus M was the current account balance. The current account balance is thus X minus M plus net transfer and net current transfers and net income from abroad. Similarly, gross national disposable income for the country is C plus I plus G plus the current account balance. Now, gross national disposable income minus consumption and government expenditure is the savings for the economy. And as we know, savings minus investment is the current account balance, or if we add net current transfers and net capital transfers and the net change in the purchase of non-produced non-financial assets, we get an equation current account balance plus NKT, that is net capital transaction, and net purchase of non-produced financial asset, this must be equal to the NFI or the net foreign investment in the economy. Now, why is current account balance important? This is important because it shows the change in the savings vis-a-vis investment in the economy, or how much saving is to be changed to balance the current account deficit or surplus in the economy. This may also be an indicator how policies like tariff, quota, export incentives can be used to control the current account disequilibrium of the economy. And this will provide national cushioning for the economy as whole. Now, we can also show current account balance as a negative of the FDI, the net foreign borrowing of the non-banks, the change in the bank's net foreign assets, and there is a residual term which is known as other foreign items. So, current account balance is negative of FDI, NFB, delta NFA, and OIN. Next, we are going to talk about the current account sustainability. The current account surplus for a country indicates that the country is exporting more than they are importing. In other words, these extra surpluses are given to other countries as loan to meet their deficit. Hence, we can call this current account surplus as the net claims of the country on other countries. Conversely, a current account deficit would imply that this country is importing more than what they are exporting. That is, they are now borrowing from other countries to meet their requirement. Thus, a current account deficit will be termed as running down of foreign assets or accumulating foreign liability by the country. Now, the current account must be equal to the change in net international investment position of the country. Mind you, if we add the balance of all the countries together, it must be equal to 0 because borrowing and lending must be equal across the world. When the difference between the stock of foreign assets and liabilities is negative, the country will be a net debtor to the rest of the world. In the other world, if the country is having a stock of assets and liability as positive, that means the country is a net creditor to the world. Now, just like an individual, a country is also bound by an intertemporal budget constraint. That is, if a country is debtor in present in net terms, the country will require to generate sufficient resources in order to pay this in the future. In other words, this excess of current consumption is present is basically a discounting of future income or surpluses of the country. Now, the ability to generate future current consumption of the surplus for the economy is a requirement for repayment of existing debt, and this is known as the solvency of the country. The country will be considered to be solvent if the present value of the future current account surplus is at least equal to the current external debt. So, dear student, in this particular module, we talked about a very important aspect, which is the balance of payment, and why it is important to look into balance of payment together with national income accounting. The balance of payment shows the position of the country vis-a-vis the rest of the world. It shows the changes in the import-export balance, which is known as the current account situation, and how this current account is balanced with an accommodating flows. We also talked about the advantages and the disadvantages with the intertemporal framework for having a current account surplus or deficit. Thank you.